Warren Buffett has finally spoken out, and the message he's sharing should deeply concern every stock market investor. We might be standing right on the edge of a financial cliff, staring at an entire decade where stocks might deliver no real gains at all. Yes, you heard that correctly. 10 years of flat return. Some people believe Buffett is outdated, stuck in his old ways. A legend of the past, maybe, but not fit for today's high-speed markets. But here's the truth. Doubting Buffett has often turned out to be one of the most expensive mistakes an investor can make. History might not repeat itself exactly, but it definitely echoes. In this video, we're going to explore Buffett's latest investment playbook, a strategy that mirrors what he did before the last big market crash, when the S&P 500 gave investors zero real gains for 12 straight years. We'll show how this exact approach made Buffett the only billionaire who's actually profiting in 2025. And most importantly, we'll show you how you can copy Buffett's 2008 crash game plan to protect your wealth and possibly grow it too. Even though there's been a lot of noise in the markets, Buffett has stayed strangely quiet. Except for one huge action. Berkshire Hathaway recently sold off a massive $130 billion in stocks. But here's what's truly surprising. Since then, Buffett has been making his boldest move yet by doing nearly nothing. And that nothing? It says more than 1,000 stock trades ever could. Right now, Berkshire Hathaway is sitting on a mountain of cash, over $347 billion. That's more than a third of the company's total value, just sitting there, untouched. But instead of buying new deals, Buffett isn't picking up cheap stocks. He's not even buying back shares of his own company. Why not? Because he doesn't think anything is worth the price. Not even Berkshire Hathaway. Instead, he's putting that money into short-term U.S. Treasury bonds, safe government debt, earning 4 to 5% interest per year. That move alone is earning Berkshire around $13 billion every year, just from bonds, not stocks. That's not just a strategy. That's a clear signal to the rest of us. And it's a message Buffett has sent before, right before the dot-com crash hit. Let's go back to 1999. The markets were booming. Tech stocks were the craze. Prices were way too high and getting higher. Sound familiar? That year, Buffett's letter to shareholders, which you can still read online, gave a chilling warning. He said investors had gotten way too hopeful about future stock returns. Prices had lost all connection to real earnings and reality. And then, he predicted something no one wanted to believe, that the next decade would give investors nothing real in return. People laughed at him. They said he was outdated, that he didn't understand tech, that he was out of touch. But guess what happened? In 2000, the market collapsed. From 2000 to 2012, the stock market averaged just 2% a year, and that didn't even beat inflation. Buffett had been completely right. While most investors lost money, Buffett actually grew his fortune. During that lost decade, bonds and dividend-paying stocks beat the rest of the market. And what had Buffett done before it all fell apart? He held back. He refused to chase overvalued stocks. He built up cash. He didn't buy back Berkshire shares. Exactly what he's doing again right now. And the similarities don't end there. Let's take a look at two major warning signs, ones Buffett himself uses, that show the market may be in trouble once more. First, the Buffett Indicator. This is a metric Buffett once called the best single way to measure market value. It compares the total market value of all U.S. stocks to the country's GDP, basically the size of the whole economy. Back in 2000, during the dot-com bubble, this number hit 140%. In 2007, just before the financial crisis, it spiked again. In 2021, during another major market boom, it soared. And where is it now? 188%. That's the highest it's ever been in modern history. This tells us one thing. The market may be wildly overpriced, just like it was before earlier crashes. Second, the CAPE ratio, also called the Shiller PE ratio. It's named after Nobel Prize winner Robert Shiller. This one compares current stock prices to their average earnings over the past 10 years. Here's what the data shows. When the number is above 16, it often means we're in a bubble. Before the 1929 crash, it was high. Before the dot-com crash, high again. Before the 2008 crash, same story. And today, it's around 33, more than twice the normal level. So those are two big red flags, and they're both shouting the same warning. A correction, or worse, could be on the way. Now yes, The market has already seen some dips, and according to CNN, we're not in full-blown hype mode. People are even getting a little nervous. But here's the problem. Even though investors are feeling scared, stock prices are still way too high. So what's going on? Well, it's not just about numbers anymore. It's about human behavior. Buffett explained it perfectly back in 1999, using the famous Cinderella at the ball story. He wrote, "The line between investing and gambling becomes even more blurry when most investors have just enjoyed big wins, like we've seen with tech or AI recently. Even smart people start acting like Cinderella at the ball. They know the party can't last forever, that the clock will strike midnight and the fun will turn into a disaster. But they don't want to leave early. They want to enjoy every last minute." Then he adds, "All of them plan to leave just seconds before midnight. But there's a problem. They're dancing in a room where the clocks have no hands." That's exactly where we are right now. Everyone knows this can't go on forever, but nobody wants to leave first. Except Buffett. He's not even on the dance floor. He's on the sidelines, watching, waiting, and building up his cash. Just like he did before 2008. So, what exactly is his playbook when markets look this dangerous? Let's break it down. First, there's a popular myth that Buffett never tries to time the market. He's often quoted saying that trying to time market highs and lows is foolish and impossible. And maybe he doesn't try to guess exact tops or bottoms. But here's the truth. He changes how he invests based on the facts. Let's go back to 2008, one of the biggest market crashes in history. Buffett had once again built up a pile of cash, staying patient while others rushed into risky bets. Then, when fear was at its highest and prices were collapsing, he acted fast. He put about $20 billion into companies that were hit hard, including a huge deal with Goldman Sachs. That single move made him a fortune, while most people were losing big. And around the same time, he published a famous article called "Buy American, I Am." So, what can you take from that? 3 big lessons. 1. Patience. Buffett doesn't chase trends. He waits for the right moment. 2. Cash. In a crash, having money on hand is everything. 3. Courage. When great companies are cheap, Buffett doesn't hesitate. He buys. And now let's talk about your plan. No, you don't have billions like Buffett, but you can still follow the same playbook. Stay steady with your investing. Save up a cash cushion. Focus on growing your income so you can invest more when the time is right. That last one is key. Most people never grow their income enough to reach their investing goals, and that puts them in a bad spot when real opportunities finally show up. So let's wrap this all up. Buffett may not be giving speeches right now, but his actions are sending a loud and clear message. He's not falling for the hype. He's not buying overpriced stocks. He's not even buying back shares of his own company. He's putting money into safe government bonds, collecting a steady return, and waiting patiently for panic to open the door to real value. And when that door swings open, just like it did in 2008, Buffett will be ready. The only question left is, will you?